In our latest video on trading biases, we're going to take a look at how we can maybe set stop losses more effectively. Hello, I'm David Jones from Capital.com, and this is the latest in a series of trading biases where we look at maybe certain bad habits people can develop and look at ways of improving them. Our trading platform has an algorithm that analyzes clients' behavior and sees if certain clients have picked up on maybe a poor trading bias and try to hopefully nudge them back on track. This time around, we're going to look at setting stop losses effectively. In a previous video, we looked at the whole idea behind stop losses and why still plenty of people don't use them or maybe use them incorrectly. In this one, we'll go through some ideas of maybe how to use them a little bit better. So we'll have a look at some theory, first of all, then we'll have a look at some real markets. Let's take a bit of time to think about what we should be looking at when it comes to setting effective stop losses. Just as a recap, stop losses are there, should be an important part of your trading plan, and they are there to manage risk. Do not set stop losses too tight. So if you're trading a market that moves, let's say 50 points in a day, opening a trade and setting your stop loss 5 points away, for example, that's too tight. You're probably just going to get taken out for a loss in the normal day-to-day movements of the market. So consider the volatility of the market you're trading. In that example I used, if a market moves 50 points a day, then a 5-point stop loss is probably too tight. So think about how much the market normally moves so your stop loss won't just get taken out in market noise. Think about the financial cost of your account. This is more to do with position sizing, but most sensible trading approaches recommend risking losing 2% or less of your account on any one trade idea. So let's say you decide to set your stop loss 50 points away on a trade and you've decided to only risk losing £50 on a trade, then you should trade at a size where each point is only worth £1. So when you've thought about where your stop loss is going to go, there's another step to think about the position size. If your stop loss gets hit, what's that going to cost you in financial terms for the size of your account? Do you need to reduce the size you're trading? Let's take a look at some charts to think about where we might want to place stop losses. Here's an example of a market that has been quite volatile. This is the last couple of days for the Dow Jones index. So the market's been as low as 24,600 and as high as 25,100. So it's a market that has traveled through 500 points in a little more than 24 hours. So if a market is as volatile as this, then the market moving 5, 10, 15 points is really nothing. So you need to bear in mind that market volatility when you're trading. So think about setting your stop losses in extreme positions. For example, let's say we were thinking to buy, this is a 5-minute chart we're looking at, an obvious level where the market has not traded below today is 24,600. So we may want to think about setting a stop loss somewhere beyond here. If the market breaks below, then maybe things have changed. You may not want to buy up here. You may want to wait and see if the market sells off and holds above these old lows. But the point is, don't just pick stop losses randomly, particularly in a volatile market where you're just likely to get taken out by the day-to-day noise of the market. Think about big areas where the market has turned away before for when it comes to setting stop losses. Foreign exchange markets are of course very popular with traders. Here's a week of euro dollar, again just to get a feeling for the volatility. The market's been as high as 115.60 and has traded as low as about 113.40. So in a week we've seen a range in excess of 200 points. So again, if we're looking for maybe a more medium-term trade on a market, think about the sort of volatility we normally see and set stop losses accordingly. Let's say you thought you wanted to hold a position in euro dollar that ran for the next 5 days potentially. Again, you don't want to be setting stop losses 10, 15 points away from where you get in. This is a market that's moved 200 points in a little over 5 days. So we want to give the market time to prove us right and not get stopped out just in the normal day-to-day market noise. So setting stop losses is, I think, something of an art, but with a bit of practice, you'll find out, I think, fairly quickly what doesn't work, and normally it's setting them too tight. So hopefully that's given you some ideas on how to better use stop losses. Rule number one is use stop losses. Have something that manages the risk on your trade, but don't set them so tight that you'll just get taken out in short-term noise in the market. We want to try and hopefully set them beyond obvious points. And once you've decided on your stop loss level, it's the all-important position sizing. How big do you trade, and what sort of financial risk will that be with you? Does that fit with your trading plan? There's a whole host of other content on our YouTube channel looking at trading biases, market outlooks, trading strategy. But for this time, from me, David Jones, and Capital.com, for this latest video on trading biases, we'll leave it there.